Okay. All right. So in class 3, we are going to cover steps 5 and 6 of our 10-step program here. So in the first 2 classes, we've covered perms and temps, and then step 1, our current. Step 3 here is really just fixing our current, and then what's listed as bullet 4 is what I called step 2, our deferred. And then tonight we're going to cover 5 and 6. Okay? So 5, account for uncertainties. So that means if you're a company that has tax exposures and you haven't already included a tax payable with your tax return, you might still need to account for a tax exposure. So just like a company would account for like a litigation exposure or an environmental contamination exposure, you know, companies accrue for exposures like that, right? Tax is no different. So the next chunk of what we're going to talk about is how do companies account for tax exposures, okay? And the context on that is that let me just flip the slide here. So the context is that when I was young, the rules were like far and few between. And it used to be that there was just basically one sentence that told you what to do. And it said that if a loss was probable, then you accrue a loss. Okay? And like that was it. That was the rule. And so as you can imagine, companies might interpret that differently. Right? And some companies, they don't want to accrue a loss, because accruing a loss means you have to expense and reduce your earnings, right? And usually companies like earnings, and so you wouldn't necessarily want to make an accrual if you wanted to keep your earnings as high as possible. So when you have like vague rules like accrue a loss if it's probable, then depending on like the answer you might want, you could sort of interpret that vague rule one way or another, right? So again, like when I was most of your age, that was the rule. And companies would accrue tax exposures as a liability on their balance sheet based solely on whether the loss was probable. And one of the most common questions that would come up was, well, I don't even think I'm going to get audited. Or if I do get audited, like say Sui Yen's on my case, right? She's not going to catch it. Like I'm so slick, there's no way Sui Yen is going to be onto me, right? So like should you factor that in, right? Is it probable that I'm going to get audited, that Sui Yen's going to find the issue, and then she's actually going to be able to convince me that she's right and I'm wrong, right? Like, do you factor all those things into what's probable? That's weird that you would be able to accrue financial statement liabilities based upon the odds you'd be audited. Like, that doesn't sound like appropriate accounting at all. That sounds terrible, right? That's sort of like I'm going to accrue for lots of exposures based upon the chances I get caught, right? That's just not how things work. But the problem was the rules we're going to talk about tonight was that the only guidance that companies had was that you accrued a loss if it was probable. Before the rules we're going to talk about here in a minute, companies had almost no disclosures in their public filings. So if you pulled up a 10K for EA from 2005, let's say, if you pulled up their 10K, it would say almost nothing about tax exposures, is my guess. And it might include, I don't know what it says, but it might include a statement that says, like, we're adequately reserved. And so that might mean they have no reserves and they think that Sui Yen will never catch them. Or that might mean they have tons of reserves, in which case, if Sui Yen catches them, it's no problem. But the statement we're adequately reserved doesn't tell you anything about whether they have reserves or don't have reserves and how you might interpret what is adequate relative to what they might interpret. They're just telling you, like, we got it, don't ask any questions, right? We're the professionals there, right? So FASB sort of decided that this was just bad, right? It was just bad accounting, that the rules were not well defined and that there wasn't enough disclosure, there wasn't transparency, right? Like if you bought stock in a company, you don't know if you're buying stock in a company where there's a huge tax risk because they haven't filed tax returns for the last 20 years or not, because companies just aren't disclosing these exposures. Like there wasn't rules to create the obligation to be transparent like that. And so so new rules came out. It's been a long time now, but this is what was called FIN 48. And FIN 48 is now codified as part of ASC 740. But the purpose of FIN 48 was to put a bunch of rules in place so that people had to follow like a regime to determine what a result was. And that regime would, in theory, create consistency amongst companies. So if you had 3 companies that had the same issue, you would get to the same accounting result. And those companies would also have disclosures to tell you what they accounted for as their exposures. So you as a reader could feel like if you bought stock in, say, Google and Facebook and they had the same issue, that you knew that their issue was accounted for similarly. You could see it disclosed, and you could make an informed decision as a reader about whether you wanted to buy their stock based on full information about their finances, right? And most people aren't buying stock based upon taxes, but if tax was a really big deal, then you'd want transparency, right? So the purpose of FIN 48 was to create specific rules and then create requirements for disclosure and transparency. Okay? And FIN 48 it sort of went like the opposite spectrum of the rules before. So whereas before it was really vague and it was open to interpretation, now it became like really regimented. Okay, so there are basically 6 steps that we're going to follow to implement FIN 48. The first is we're going to figure out what our position is, because we're going to apply these rules to every position we take on our tax return. Then we're going to, step 2 is we're going to look at that position, or each position, and we're going to evaluate it for something called recognition. And this is sort of like a pass-go test. Okay? So what recognition means is if you took a position on your return, so like let's say Aaron, he's our designated R&D guy. Let's say he claims an R&D credit, okay, on his tax return. But let's say that he owns a landscaping business. So there's not a lot of R&D going on. But he's like, I heard everyone in the Valley claims R&D, so I'm putting R&D on my tax return, right? So he doesn't have a chance of winning. Like as a technical matter, if Suyen catches him and says, you're not doing R&D, he's like, you got me, right? Like there's no technical basis for what he's doing in terms of claiming an R&D credit. So he would fail the recognition test, okay? And the recognition test says, based solely on the tax merits for the position, are you at least 50% or 50.1% likely to win, yeah? And if you are, you can keep going. But if you're not, you have to reserve the entire position you took. So in my example with Aaron, if he claimed $100 of R&D credit, and he's like, there's no chance I can win. If he followed the rules, he would have to accrue a reserve for all $100. Okay? And so on his financials, he would have a liability for 100, and he would say, I didn't even pass the recognition test. I didn't even have any merits to my position. And so I couldn't even go on and try to analyze this thing further under the rules. I just stopped here. Okay? But if his position was like some innovative thing around landscaping, like let's say he knew how to like make grass grow slower or something, so you didn't have to cut it as much, right? And he was like coming up with some cool design, and like maybe that qualified for R&D. Well, then he can keep going. Okay, and he can determine whether that $100 R&D credit needs to be fully reserved, partially reserved, or not reserved at all. Okay? The question he's trying to answer is, he took a benefit for the credit by reducing his payable. Now he's trying to figure out, should I set up another liability in case the tax authority comes back and assesses me tax? So that is the purpose of this section. Should we set up a liability to anticipate having to pay more tax? Okay. Step 3. So once you pass go, right? Once you pass step 2 and you get past recognition, then you need to look at your position on a settlement basis. So a lot of things can happen in the real world with respect to tax positions. If an auditor comes and audits you, lots of different outcomes can happen. So your auditor could be really lazy and could say, look, just give me like 20% of your credit, and then I'm just going to read the newspaper, and then in like 2 weeks I'll write you a report, you'll sign it, and then you'll be happy that I'm gone and I got something and we're all good. Like, that could be one outcome. Another outcome would be this person is like really principle based and would say, like, I want to get to the right answer, so I want to meet your engineers and I want to like learn about your R&D and I want to take a lot of time and figure out what the right answer is, and maybe depending on what I find out, we'll negotiate a different outcome, right? Maybe the person's like, no, you're a total fraud, I'm disallowing your whole claim, and then you can litigate with the IRS if you want to try to get any of that credit. Good luck, right? So like, those are lots of different kinds of outcomes. So what you do in the measurement phase, the step 3, is you take a position and you try to put odds on what's going to happen, right? So like, what are the odds my agent is just going to like take some arbitrary haircut? What are the odds that like I'm going to get a rigorous like scrub and I'm going to be in trouble? You try to be kind of an odds maker and come up with an estimate of what you think is going to happen. But again, you only do that for positions where at least you think you would have a more likely than not chance of winning technically. So in this measurement phase, you get into like more of the practicalities of what might really happen, right? Because most audits aren't decided on purely technical grounds. They're decided on like, you know, does the IRS auditor hate you? You know, does the IRS auditor have pressure to close an exam? It's things like that factor into this, right? You said.
So the more likely than not is just for step 2. Once you've passed it, the measurement piece is you're going to win on technical merits, but are you going to win 100% or are you going to have to do?
That's a fair way to say it, although this measurement test also includes more likely than not terminology, so it gets confusing. We'll explain it in a bit. Okay. But what he said is pretty accurate, right? First you identify what position you're talking about. In our example, it's R&D. First, then you decide, do I think just technically, am I going to win? If this was like Supreme Court and nothing else mattered, tax law is all that matters, will I win? If so, okay, well, I'm not probably going to take this to the Supreme Court. So now what's really going to happen, right? Like, that's sort of the logic here, okay? And the way that companies have to apply the rules is like in sequence like this, okay? Step 4, 5, and 6 are really more about the transparency side of this. So how do you classify a liability? Do you put it as non-current in your liability section because you may not pay it for a long time? Do you show it as current? Do you set it off against the DTA? All that kind of stuff. Interest and penalties. So now anytime a company accrues a reserve, if they would owe tax, what happens when you pay additional tax, like when Sui Ann gets you, is she will charge you interest. Like, that's what happens next. And so the rules under FIN 48 require you to accrue interest for any time you accrue a reserve. Okay? So before FIN 48 came out and you had this like loss probable thing, like people were like, I don't know, interest, you know, it's such a vague rule, maybe I'm not going to accrue interest. But now it's very clear that you need to accrue interest. And then the last thing is disclosures. And when we get to the disclosure section, we'll just pull up EA's 10K and I'll show you where all the disclosures are, because every company has the same disclosures, and that's because they're all required. And most of the companies hate them, but if you really try hard to see what's in there, it is hard to figure out. Like, the disclosures aren't that helpful in a lot of ways. It's confusing information. But if you compared like a 2005 10K to this, like you would be blown away at the difference. I should have had, next year when you teach this class, you can add that as your example, the 2005, 2015 example. All right. So those are our steps. Okay, so I'm not going to go over every slide. So, actually, let me back up a second. You're supposed to identify every position, and then they have this concept of determining a unit of account. That concept has sort of become, in practice, antiquated. Like, people don't really use it, but it's in the guidance. And what they mean is, like, if Aaron claimed an R&D credit, and, or let's use, like, a real example. So let's say that, Rumi, where are you at, Rumi? All right, so Rumi works at Oracle. Oracle claims an R&D credit, I'm pretty sure. Do you know? I'm just messing with you. They definitely do. All right. So the way that they claim an R&D credit is they probably have like more than one project, right? I bet they do. So they probably are like project 1, project 2, project 3. So if the IRS came and said, oh, we're going to audit your R&D credit claim, and the way we're going to do it is we're going to audit each project and then make a conclusion on each project's like likelihood of being sustained, and then we'll just add up, you know, the sum of each project, and then that'll be your total R&D credit. The theory behind FIN 48 is you should apply all these rules on a project-by-project basis within your R&D credit. So your unit of account should be the way in which the IRS or the relevant tax authority is going to audit the issue. So like you can imagine applying some sort of accounting rule project by project to assess the likelihood of your winning and settlement. And like when companies started like disaggregating positions to comply with FIN 48, they're like, this is a lot of work. And then the next thing they're like, well, we shouldn't do this anymore. We should just like get big units of account instead of lots of small units of account. So now when you see a company's documentation around FIN 48, it's like R&D credit, 199. Sometimes it's just transfer pricing. Sometimes transfer pricing can be broken up into different things. But you don't normally see lots of little things analyzed. You normally see bigger chunks. And the reason is it's just more practical for companies to comply that way. Okay? So what Oracle probably has for their FIN 48 documentation for the credit is they probably have, they say the credit is our position, and when the IRS comes, they're going to look at the credit, and we're going to negotiate a settlement on the basis of the credit, and we're not going to negotiate project 1 separate from project 2. It's going to be one big negotiation. Okay? And so that's their justification for analyzing the credit as a whole as the position. Okay? It's not on the exam, don't worry about it. Okay. Next thing. So now we get to the credit, and we're going to our recognition test. And remember what Yusef was saying earlier. This is just you determining, you know, if on a technical merits basis alone, would I win? So Oracle's going to say, yeah, we do R&D. Like, that's how we succeed. We make new stuff, right? Our new stuff is cool. It does new things. That's R&D. We should get a credit. We should win. And I know that's like a broad generalization, but like you can see how a company like that should be able to claim an R&D credit. And now it's really just a question of like nuances, right? So like if you change the package color from red to blue, like that's not awesome R&D. But if you made it run 3 times faster, like that's R&D. So you know, there are nuances within R&D spend that might be good versus bad R&D. But still, like if the question is, do you get a credit or not? Oracle gets a credit, right? Okay. Importantly, when you make the determination of the recognition test, you're supposed to go along with the assumptions on the right-hand side of the slide. And this is like the exact sort of thing that FIN 48 created because it thought it was dealing with abuses pre-FIN 48. So it said that when you make the conclusion about more likely than not, you have to assume you're going to be audited, so you can't play audit lottery. You have to assume that the examiner has full knowledge of the information. You have to assume that you can't like give away your 199 deduction to save your R&D credit. You have to look at these positions individually. You can't horse trade. You have to and analyze the decision solely on technical merits, and you should think about court of last resort. Okay? So this is like more like an ivory tower sort of thing. But the important thing is you're supposed to assume that you're going to be audited and the tax authorities have full knowledge. Like, that's not reality. Right? Like, when Sui-Yen comes to Rumi and says, they tell me about your R&D credit, Rumi's going to be like, there's not much to say, man. We just do like a lot of cool R&D. Right? And so all the details behind that credit, like the fact that, there's a lot of G&A in there, let's say, as an example, we're supposed to assume that the tax authority is going to know all that in order to make this conclusion. But that's a difference from the real world, right? So companies, when they apply FIN 48, they get really frustrated sometimes that they have to assume a fiction that's not real. Okay? All right, that's recognition. Measurement. Okay, this is where the fun is truly at. If you're not having fun yet, you have fun now. Yeah. Measurement. So remember what I said earlier is once you pass go, once you get past recognition, you're like, I think I'm going to win based on technical merits, but still I'm going to get audited, and I'm probably going to settle at something, because like that's just how life works, right? It's like you go buy a car, you're not going to pay sticker, it's going to be somewhere in between, and then that's kind of like how measurement works with FIN 48. Like, what am I going to pay? How much time am I willing to waste at the dealership, right? How willing am I going to be to go to another dealership, How willing will I be to buy a different kind of car? Like, that's kind of how measurement works in an income tax setting, okay? So, now here's the dumb way that FIN 48 does this, okay? So, remember how Youssef asked about the more likely than not concept? Well, there's a more likely than not concept in measurement. And there's a technical way to do this, and then there's a practical, okay? So I'll explain the technical first. So, if you look at the example at the bottom corner of the slide, hopefully you can see it. What you're supposed to do is you're supposed to identify the likely outcomes. What could happen? Okay? And then you're supposed to put individual odds to it. Okay? So say Rumi claims his R&D credit at Oracle, and he claims a $100 R&D credit. And then he sits back and he's like, well, what could happen here? Like, what ultimately, like, I think I'm going to win, but what's going to possibly happen? And let's say that hypothetically he says, well, I could win the whole thing, and I think there's a 15% chance of winning the whole thing. Or, like, maybe I give 20 away and I keep 80. And, like, I hear some companies do that. So I'm just going to say there's a 20% chance of that happening. Right? Because I feel pretty good about my credit. I don't know why I'd give away more than that. But I'll give away something if they promise to leave. Right? Like, that would be a typical settlement outcome. Or you can see the next three scenarios are I keep less, and again, I've assigned individual probabilities to each of the outcomes. And that could be for these like sarcastic things I'm talking about in terms of your relationship with the IRS. It could be things like, well, there's really some gray areas in the types of expenses that I'm qualifying as credit. It could be lots of reasons that, it could be like I was saying, if you want to settle at the agent level at an exam and not go to appeals, you might get a different outcome, right? Because there's more work involved going to appeals, more costs. So the way FIN 48 is supposed to work is you're supposed to identify the likely outcomes. Here we have 5. And each of those outcomes you're supposed to assign an individual probability percentage to. And the sum of the individual probabilities should add up to 100. Okay? So you're playing odds maker with what's going to happen to your credit. Now, you're supposed to use the assumptions on the right-hand side of on the page. So you're supposed to assume I'm going to be audited, the examiner has full information, I'm not going to horse trade. But now the fourth one is where things change. The evaluation should be based on all relevant facts, circumstances, and information. So like if your agent hates you, like now it's relevant. Right? So if you're assessing like your likely outcomes and the individual probability of that, like if your agent is brilliant and you're like, I don't even know why I claimed a credit, and this person seems to like really know what they're doing, like you might, take that into account. Or if you're like, I got this like kick butt attorney, like he never loses, you can take that sort of thing into account in this process. Okay? So now, here's the punchline. You're supposed to identify the third column of this chart. Okay, the key is this column. Okay? And you're supposed to identify the cumulative probability of the different positions. And what cumulative probability means is if there was a 15% chance of winning the entire $100 credit and a 20% chance of getting only 80, then that must mean that the chances of getting at least 80 is 35%. Does that math make sense to you? Right? So the odds of you getting at least 60 is going to be the sum of the odds of you getting 100, the odds of you getting 80, and the odds of you getting 60, or 55%. Okay? So that number, that $60 outcome, the cumulative probability of that happening is more than 50%. So you book that. That's the answer. So what, in this example, that said is 60 is the credit I'm going to keep, so 40 is the liability I should set up. So remember, we said the goal of this is to figure out how much liability should I set up on my balance sheet. The answer is 40. The way you got there is by putting individual odds on likely outcomes and finding the outcome that had a cumulative probability that was more likely than not, or above 50%. Now in reality, what people do is instead of having this silly chart, they'll have like 3 outcomes. And this isn't always the case, but this is very common. Companies will say, I'll win it all, I'll lose it all, I'll settle. And they'll say the odds of winning it all are like 10%. The odds of losing it all are like 10%. The odds of settling are 80. So the answer under a cumulative probability is going to be the settle, right? So whatever you estimate as your settlement number, that's the answer. Like that's typical FIN 48 documentation when you're really just trying to shortcut it and say, I might win, I might lose, but really I'm going to settle, and here's my best estimate of what I'm going to settle at. Like that is a very typical approach. Don't think that that's always the case. Like I don't mean to make it too dumbed down. Like there are reasons why you might end up at like staggered places. Like you might lose project 2 but keep everything else, or you might lose projects 2, 4, and 5 and win everything else. Like there could be reasons you get to different outcomes that are logical and don't look so arbitrary. But that's how this is supposed to work in the measurement phase. Okay? All right, questions on that? Yeah.
How did we reach to the liability as 40?
How did I get the liabilities 40? Well, remember Aaron or Rumi, they took a credit of 100. That was their benefit. And then this chart tells us we're going to be able to keep 60. So 40 is the liability we got to set up. Okay. So once we determine we need a 40 liability, the question is we got to determine whether we should put it in the current section of the balance sheet as a liability or as a non-current liability. Before FIN 48, a lot of people thought it should be current because they figured the IRS could show up at any time and ask for their money. Now the rule is you book it based upon when you think you're going to make the payment. And most big companies think it's going to take forever to make these payments because audits take forever. And so you will almost always see an account, if the FIN 48 is material enough, called non-current income tax liability, and that means that's their tax exposure. Sometimes you don't see it because it's not big enough to show separately and it's just netted, but almost everyone books their exposures in the non-current liability balance. Okay? If you have a liability that like let's say that Rumi claimed $100 of R&D credit and didn't use any of it. They broke even, so they carried forward all 100 as a DTA, but then he was going to lose 40. Now the rules say you would just show a 60 DTA. Like you would net down the DTA to reflect what you're going to keep. Okay? So when I say the goal is to figure out the liability on the balance sheet, it's really to figure out the credit side of the balance sheet. So it could be booked as a liability if you owe tax. It could be booked as a credit to deferred if all you're doing is reducing attributes. figuring that out is hard for big companies with like lots of things moving on. Like, I don't know Oracle's situation, but if you said like how many years are they open for audit right now, if you said like 10, I wouldn't be surprised. So figuring out like tax exposures and attributes and stuff like that, it's confusing. Okay, we talked about interest and penalties. You got to accrue it. Disclosures. Okay, let's talk about EA. All right. So in EA, remember I showed you how every company has this what they call tabular roll forward. And they roll forward the unrecognized tax benefits from year to year. Unrecognized tax benefits just means the tax reserve. It's the 40 in our example. Okay? So EA has 232 million of 40s, right? And so they tell you what happened. They say, hey, last year we had 297. We increased it a bit, decreased it a bit, we settled, some stuff we got away with because the statute lapsed, and now we have 232 left. Okay? So they're telling you that on their balance sheet they've recorded 232 million of credits related to tax things that they think they might lose if audited. Okay?
And this is actual tax dollars.
These are tax dollars. Okay? Does that seem like a lot or a little? Yusef says little. See, Yusef only plays with the big players. You know what your number is, Yusef?
Actually, it's not that large. About 100 and something.
So, like, I think, Ozzy, you said Merck, right? You looked up Merck. Do you have their 10K handy? No? Like, I'll bet Merck's 232, like, if I had to guess, I'll bet it's between 5 and 10 billion. Yeah. I know, right? The pharmas are the big ones. Yeah. So, like, weren't we talking, was I talking with you guys about the company that got in the news for having a big tax assessment? Coke, right? 3 billion? Yeah, it's 3.3 billion. And what the IRS said is you put money in a foreign jurisdiction that we think should have been taxed in the U.S. It's just that simple. So go ahead and pay us 3.3 billion, right? And that's how the pharmas are, right? I mean, they sell their products around the world, and the IRS is like, hey, so more of that could be coming to the U.S. through by way of royalties. And the pharma companies are, you know, they have sophisticated structures, and they think profit in large part should be offshore. And there's always that tension of, is the profit of a business subject to tax in the U.S. or not? Like if you pulled up Merck's 10K or Gilead, huge amounts of offshore earnings, right? Same with like Apple, Google. Think of any of these companies that just print gobs of money and operate globally. They will always have huge UTB amounts. Okay? Yeah, it's interesting. Like I think when you look at public companies, if you looked at the and there was a Senate investigation on this where they categorized like the top 10 or 20 companies' UTBs, and they just added them up, and it was like 100 and something billion, right? And they were like, man, if we just, and you don't even know if this is U.S., but you probably assume it's largely U.S. And you just think, man, we could go get $100 billion by auditing 10 companies. Like, that's crazy, right, in terms of like the amount of tax that's lost in the system. So there was a report. I thought I used to make it part of the homework. In fact, maybe take a note, Kate, and we can make these guys read it because it's super interesting. There was a report out of a Senate investigation committee that looked at high-tech companies and their tax structures and why they were so aggressive. And it wasn't trying to like criminalize the companies so much as it was to show like the rest of Congress how the tax laws needed to be reformed. They're like, it's full of holes, right? These companies have low tax rates, big reserves, you know, we're just losing. And it had a lot to do with this whole like offshore earnings concept that is what drives a lot of high-tech companies. But FIN 48 disclosures and the unremitted earnings disclosures were a big part of it. So it's interesting reading. Okay, anyways, disclosures. So EA has to tell you every year what their total reserves are. Like in theory, you want to know, right? Remember how much Nordstrom was? 15 million, right? It's like nothing. They're like, we make money, we sell junk to you, we pay tax, we're all good, right? We're not shady, nothing to see here, right? EA, you're like 230 million, what's going on, man? Why can't you pay the right amount of tax, right? You're not a huge company. But then you go look at these other big companies and you're like, wow, this is big. So you really get a sense for like the scale of, if you were in the tax authority's position, like how these disclosures might change your behavior, right? Because if you were a tax auditor and you showed up at EA, you might think, so I'm kind of interested in collecting 232 million, right? But you don't know what year it is. You don't know what positions these relate to. You don't know if it's like states or foreign or U.S. Like, you just know it's 232, right? But that's a lot more than you knew before these rules, right? Okay. When we're going to come to a minute, we're going to come to a second here about the IRS disclosure that's required now too. Okay. So, this is them disclosing the roll forward for the last 2 years. Same junk. The next disclosure is a portion of our unrecognized benefits. I guess I was reading from an old number. Our number now is 254. A portion of our unrecognized tax benefits will affect our effective rate if they're recognized upon favorable resolution. As of March 31/15, approximately 58 million of these UTBs would affect our effective rate, and 195 million would result in adjustments to the VA. So that's kind of saying that 58 million of their exposures are non-U.S. and 195 are U.S. Because if you read their disclosure, you know they have a U.S. valuation allowance.
Wait, sorry. Say that again, 58 million. Why is it non-U.S.?
So we haven't read their full disclosure yet, but if you read it, which you should have because that was the homework, you would know that they have a U.S. valuation allowance. So the deferred tax assets that they record in the U.S., they record a valuation allowance against them. Okay? They don't say that in the same way for foreign jurisdictions. Okay? So in a way, they're saying we make money in foreign countries, we lose money in the U.S. This disclosure is saying worldwide we have 254 million of exposures, right? And they're saying if we recognize the 254, let's say we won it all, 58 of it would impact our provision. It would give us a great provision answer because we would win. But the other 195 doesn't change anything for us because all it does is impact our valuation allowance in the U.S. Okay? They don't say the words foreign and U.S., but if you start like connecting the dots, you can figure it out. So now if you're the IRS, you're like, I guess maybe not 254, maybe 195 is what we should be paying, right? Like you could start, if you were smart, you could sort of start thinking about like what would be relevant to you. You have to disclose interest and penalties, so they say the combined amount of interest and penalties is cumulatively 16 million. So if they got busted on all 254 million of their exposures, they'd have to pay 16 million of interest. You have to tell the reader what your key jurisdictions are. So they say the key ones for us are U.S., Canada, France, Germany, Switzerland, and U.K. And then you have to talk about, of those key jurisdictions, what years you're being audited. And then this is sort of one of the doozies here. You're supposed to say what you think is going to happen in the next 12 months. Like you just said, I have 254 million of reserves. Like, what's going to happen in the next 12 months? Am I going to have to pay $254 million? Am I going to win it all? Is that like way under reserved and I might have to pay $700 million? Like, you're supposed to provide a prediction, which is a weird thing because that's not what normally like 10Ks have. But there's this 12-month rule. And so what they say is, although the potential resolution of uncertain positions involves multiple tax periods and jurisdictions, it's reasonably possible that a reduction of up to 11 million of UTBs may occur within the next 12 months. So of that 254, they think maybe 11 will clear. Some of which, depending on the nature of settlement, may affect our provision and may benefit the resulting rate. It could vary. We don't know. We don't know why we told you any of this, right? It's because we had to say something. That was a requirement. So there's almost no 12-month rule that you'll ever find for a company where you're like, that was cool, that was like really informative. Because if you think about it, right, if they said, you know what, I think in the next 12 months, we're going to win all 254 because the statutes are going to lapse on all of them, and like we haven't been audited yet, and I don't think they're going to catch us. And like if the tax authorities were reading the 10K, and they're like, huh. Right, they're like, dear EA, right, we would like to audit you. So the disclosures aren't that granular or transparent because companies want to comply with the rules, but then they also don't, want to put themselves at risk for, they don't want to weaken their position with the tax authorities. Right? And it's not like they're really trying to hide stuff, but it's, they're not trying to give it away either. Okay, so that's a typical disclosure. Skipping because we're having fun. Okay, last thing on FIN 48. So now, so the IRS then, accounting rules changed in 2007. Everyone needed to do this. Lots of work. People like me stay busy helping companies comply with FIN 48. FIN 48 is a big deal. Lots of disclosure. All the words that are said in a FIN 48 disclosure in a 10K, they're carefully reviewed. Man, I have this one client that they they have an army of attorneys that pour over every word, nothing is said, casually. So then the IRS said, oh, look, man, you're giving the reader all this information. Wouldn't it be great if with your federal tax return, you just told us which positions you accrued reserves for GAAP purposes, and then we'll just know which ones to audit, and that way we won't have to spend time looking. Right? You know what I mean? That makes their life. If you were the IRS, pretend you're the IRS for a minute so you have compassion. And you said, man, I don't want to go look for your crazy, meals and entertainment thing that you're trying to hide as some other GL account and, it's really difficult for me to go find. Just tell me that you took some aggressive position and then we'll talk about it and we'll come to some reasonable outcome. And that way, it's such a more efficient use of the government resources. Why should the government be spinning their wheels looking for stuff you hide? That's dumb, right? So if you have an R&D credit reserve, tell us you have an R&D credit reserve. Don't tell us how much it is. Just tell us you reserve for the R&D credit. Tell us why, because you think, the expenses may not qualify. And then we'll audit you and we'll talk about it. And then it'll be quick. It'll be efficient. We won't waste time. And then it'll be great, right? If you were the IRS, that's how you would think. And so they came out with this form that's called Schedule UTP, which stands for Uncertain Tax Position. And they said, because FIN 48 makes you do all this stuff, position by position, we know you have all these records. We know you know for your 199 what your reserve is, and your R&D what your reserve is, and TP what your reserve is. So just take that same information, put it on a tax form, attach it to your tax return, and mail it in. That's the rule. That's what companies do. And it's kind of a bummer, right? So the funny thing is, if you're a company and you think maybe you need a reserve and it's for some issue that isn't obvious, right? Let's say that you're taking let's say that like you have a arrangement with like a foreign sub where you might have a deemed dividend, okay? But it's complicated, you know, and it would be hard to figure out. And let's say it's not that big. You know, let's say Oracle has an exposure for a deemed dividend, or let's use EA. Let's say there's a deemed dividend risk, and it would cause like a couple million of tax. So a couple million, like, you know, if you found that on the street, you'd bend over and pick it up. But it's not like, you're like, oh my God, right? Like, we got to stop everything. You know, it's huge. It's not like that. So if you thought, if you were the head of tax and you said, should I set up a reserve for that? Like most times, you'd say, sure, you know, I think I have exposure. I go through the FIN 48 rules. It tells me, you know, I got to assume that the tax authorities know the information, and then I'll settle at like some rational point. But then if I know that that's going to go on an IRS form where I say, oh, I got a reserve for a deemed dividend with this foreign sub X, now the tax authority is like, oh, so it sounds like we got this issue with the deemed dividend and foreign subsidiary X, so why don't we talk about that? And the head of tax is going to be like, duh, like we probably would have never talked about that but for that stupid form, right? And so what happens is that person who's making a decision about whether to accrue now decides, maybe I don't want to reserve, right? Because if I reserve, then I disclose. And while you're probably sitting there thinking, well, is it optional to reserve? Well, no, it's not optional, but everything has its like nuances, right? So what's interesting is FIN 48 was meant to bring like more stuff into the population of reserve, right? It was meant to like identify every position, make you go through the FIN 48 analysis for everything. And then once the FIN 48 information was then shifted into the IRS tax compliance, people started saying, hey, maybe less reserves is better, right? And there are statistics now, because there have been enough years that have gone by in terms of the Schedule UTPs that are filed, and it's something like 2.4 positions per like large size company is what goes on a Schedule UTP. Like it's a very low number. And you're like, really? Big companies only have 2.5 positions on average? That's insane, right? So what happens is like every company has a transfer pricing reserve. Every company has an R&D credit reserve. And then some companies have another one or two. That's it. That's what you see. So the Schedule UTP and the IRS reporting has like reverse engineered a bit how FIN 48 works. Because if you think like as the head of tax of a big company, what I do for accounting now shows up in my tax return, which dictates how my audit strategy works. Well, now I got to think differently because I want to start with how my audit strategy is going to work. So what should I put in my tax return? Well, then I guess that needs to dictate what goes in my accounting. There is no way that's what the FASB people wanted when they wrote FIN 48. But like in the real world, that is part of the dynamic. So one very interesting thing about understanding FIN 48 is not only is it accounting, it's a link to tax return compliance and transparency.
Can you apply materiality
Can you apply materiality to what?
to a position as to whether you do or don't disclose it?
To whether you do or do disclose it. Okay, so you asked an interesting question because I could interpret it two different ways. If you accrue a reserve for a deemed dividend of, say, $7, then you need to put on the form, I have a reserve for a deemed dividend issue. You don't say it's $7. You just say I have a reserve, it's for a deemed dividend.
So if you apply materiality to the reserve in the first place, it doesn't appear.
So that's the second way to ask that question.
Right.
So if you said, oh, it's only a $7 exposure, I don't need to reserve it, it's so small, who would bother? You can absolutely do that. And so like you're Intel, right? And so you're big, and so you have the benefit of like little issues can slip by, right? If you were at some small company where the auditors like don't let small things go by, then it doesn't work for you. Make sense? Okay, all right. FIN 48, that was spectacular. Okay, so now we have a problem. So remember the problem we started the class with tonight? Now we have another problem kind of like that where you're going to do it. So instead of you watching me and you're like, that was easy, you're going to do it. And then it includes a FIN 48 assumption. Okay? So the FIN 48 assumption, you need to figure out how does it go into the provision. Like how does that thing affect the provision? But really the hard part of this is just doing another provision problem. Okay? So I would say like 85% of what you're going to do now is just another provision problem. Practice your skills. But it now includes an added assumption around FIN 48. Okay. So you're going to work together. You guys like seem like you're doing an okay job of like mixing it up. Not awesome. So spin your chairs around, work with other people, do it in groups of like 3 or 4. Try to figure out the problem. It's going to take you a little while. But try to work quickly. We don't have forever. It's 8:30. Okay? Okay. So, first of all, anyone know who Big Tom Boonen is? None of you guys? Does anyone know who Big Tom Boonen is? That's a real person. No? Oh, you guys are terrible. I couldn't hang out with any of you guys.
The next exercise at Rainier, is that the beer?
No. Tom Boonen is a pro bike racer. Yeah, he's one of the coolest. Yeah. Anyways. Does he have a what? Maybe. Anyways. Okay. So, he's got income. He's got an inventory reserve, depreciation, tax-exempt interest, R&D credit, and then we're in a couple states. That's confusing, right? Yeah, that's kind of messy. So, we're going to have to do states first and then federal, right? So we can do this one of two ways. We can do it the slow way or the fast way. So we're going to do it the fast way. So we're going to turn 2 states into one, magically, right? We're going to make a blended state rate, okay? So the way we're going to do that is we're going to say that in state 1, so state 1, our effective rate is, apportionment is 80% and the tax rate is 5. So 80% times 5% is 4%. So its net of apportionment rate is 4%. And then state 2 has apportionment of 30 and a rate of 10. So its rate is 3. So we have a total state rate of 7. Okay? So let's just assume we have one state and its rate is 7. This wouldn't work if the states have like different adjustments in terms of how state taxable income works, but we have a simple example where we don't have that. Okay? So we're going to blend them. Okay? So if you were using our little Excel template and you wanted to make like state provisions work with multiple states, you could just do a simple blending, right? Again, it doesn't always work, but it'll work in our simple example. Okay. So now we're going to come up and do our state provision first. So, step 1. Step 1, we're going to do the current. So he has $1 million of income. Oops. We're adding back $80,000 for inventory reserve. Shooty, you better get ready with the calculator. Depreciation exceeds tax by 20. That means we got to add back 20. Right? That's an add back. $50,000 of tax-exempt interest is a perm good guy. Federal R&D credits, totally irrelevant for states. So that income is 1050 times our blended rate of 7%. What's that? 73,500. Okay, so we have a step 1 current provision state 73,500. Okay, step 2, we're going to come up with our deferreds. We have 2 deferreds. We have the 80 and the 20. So those are going to sum to 100. So that's going to be a future deduction times 7%. We have a state DTA of 7 grand, right? So our state provision is going to be a debit of this of 73.5 and a credit of 7, because that 7 is a DTA. 66,500. Okay? State should be easy, right? Okay. Not taking questions. Moving on to federal. So, federal. Step 1. We had million PBT. We're going to add back the 80, add back the 20, subtract the 50, and deduct the 73,500. Okay? 97,650. Is that what you said? Okay. So 35% of that. 341,775, and I have a credit of 10,000. So that's 331,775. Right? That's a debit to expense. Step 2, I know my 80 and my 20 carry over. Right? And then I know that I have a state DTA, which means I have a federal taxable temp. Same exact thing as our problem we started tonight with. Same direction. So I got 80 and 20. And then I know I have 7,000 going the other way, so that's 93. So 35% of that, 32550. Okay? So then I have, that is a DTA, so this is a credit to the provision. Okay? This is pre-FIN 48. If I was going to add FIN 48, what would change? I'll answer that. This 10 would become 8. This 331 would become 333. That's the only difference. Okay? All right. Rate rec. So my state provision was 66.5. Is that right? And my federal provision with the FIN 48 effect was what? When you add all that stuff together, 294 probably? You told me a number before and I ignored it. 290 something? Wait, hold on. Just shooty speak.
279,725.
But that's without FIN 48.
Yes, that's without.
So 299,255. 225. So that means it's really 301,225 once you put FIN 48 in. So that means the total provision is 725,367. Right? Okay. So then if we were doing a rate rack, we know we got to finish with 367,725. And we're going to start with 350 because it's a million times 35%. Right? So what's our differences? Chen? Chen, you're out of business. There's no meals and entertainment.
17.
For what? Tax exempt interest, right? You're taking the next best thing? Yeah, tax exempt interest times 35%, right? So 50,000 times 35% is 17.5. Is that what that is? Okay. What else? Megan, what else? Exactly. Okay, how much is that? $66.5, right? Okay. What do we do next? Priyesh, you want to try again?
Yeah, the 10,000.
No, Priyesh, we're talking about state tax.
Oh, the effect, the federal effect of the state.
The federal effect. What's the federal effect? How much is it? 23275. Is that a good guy or bad guy? Or?
Sorry?
It's not a bad guy. It's a good guy, right? We're going to pay state tax, so then we're going to get a federal deduction, right? So, good guy. So again, if you put it in as a bad guy, RAREC's not going to work. You're going to get all frustrated, right? Then you have to solve a problem. This is why I want you to do it. I want you to fail, you to fix it. Because when I just get it right, it looks easy, and then that won't help you for the exam. Okay. Does it foot? No. Aaron, what's missing?
The R&D credit.
Okay. How much is that?
Minus 10.
Is that a good guy or bad guy? Good guy. Boom. Yeah? See how fast that is? On the exam, you have like 2 or 3 of these problems. You just do them like that, like 10 or 15 minutes each. Boom, you leave in an hour. All right? Okay, that was the problem. Okay. So I was recording that, notwithstanding the handwriting is atrocious. So if you want to watch it again, at some point I'll upload these and you can watch it. Okay? All right. We have 40 minutes left, and I want to cover valuation allowances. Okay. So remember what I said. You guys can go back to your normal desk spots if you want to do that. I know most of you already have. Okay, valuation allowances. So when we do step 2 and we figure out our deferred taxes, if we're a company that has deferred tax assets, like an EA, we have to determine whether we need a valuation allowance, right? So a valuation allowance is, I always describe it to people as like the tax accounting equivalent of a bad debt reserve, right? Like if I sold something to Luis and I said, okay, here's, like this mouse or this bottle of Red Bull and it's going to cost you $5, and he's like, sure, I'll pay you next week. And then I'm like, he will never pay me, right? Like, look at him. Right? He seems like kind of a I'll pay you back kind of guy, right? So you might book a $5 bad debt reserve because you're like, why bother, right? I'll put up the receivable, but then I know he's not going to pay me, so I'll just accrue a bad debt reserve. I don't want to tell the financial statement readers of my company that I'm really getting $5 because I know I sold to Luis, right? So a deferred tax asset valuation allowance is the same thing. Like if you said, oh, I got all these NOLs and I'm going to save all this future tax, but like if that's useless, like if you're not going to really save future tax, then why book deferred assets? That's not helpful, right? So a valuation allowance is like you saying, well, I do have deferreds, kind of like I do have a receivable. It's just that they're not really worth anything, so I'm going to reserve them. I'm going to put a contra asset to show the asset really as the net amount. Okay? So if I was the kind of company that was always losing money, then I would show lots of NOLs, but then I would show a big valuation allowance. And I would say, look, you should probably just assume it's 0 because Like if I don't have a history of profits and I don't have a lot of evidence of me needing to use these attributes, I'm not going to show you them as assets, right? It's like common sense. That make sense to you? Okay. So while there are rules about how to set up valuation allowances, like when to do it, when not to do it, most of the time common sense will just get you the right answer, right? So like if you think of the companies that have valuation allowances, it's usually because they have losses. When you think of the companies that don't, it's because they don't. One of the guest speakers we had last year was a buddy of mine who, at the time, was the head tax provision guy at Verifone. And Verifone was really interesting because in the 10K, where they show 3 years of financial information, in the first year, the oldest year presented, the company released their valuation allowance. They're like, hey, we used to lose money, and things were not good, but it looks really great. And so we're going to release the valuation allowance, show you our assets, book a huge income statement benefit to set up this asset. It was like $200 million something. And so in that year, big provision benefit to create a big asset. Okay? And all that was releasing the valuation allowance. Sort of like us saying, Luis may pay us back, right? Like there's a hope. You know, he paid somebody else back. Maybe he'll pay us back. Okay? So then 2 years later, because it's a 3-year period in the 10K, like things were not looking good for the company. And like things went like from great to like not great. And they set up a valuation allowance on all their deferreds again. So oldest year, they're like, great news, big asset, huge provision benefit. Most recent year, they're like, it's not good news, right? Set up a valuation allowance, huge couple $100 million charge. Like you rarely see that where companies like release and set up all within the same 10K period. Like that is not good. That's embarrassing. You know, most companies want to be sure, right? Like I'm losing money. I know it. I'm just staying the course. Or I'm the kind of company that's going to make money, use my attributes. I don't need a VA. Usually it's like one or the other. You hate to be like in the middle, right? So again, common sense will usually like carry the day here. All right, so I asked you to think about the biggest valuation allowances. One of the reasons for that, well, there's two reasons. One is I want you to understand that the common denominator is usually the companies that are losing money, right? That's where you're going to see valuation allowances. And if you're the kind of person, like, does anyone here work for a company that has a valuation allowance? Priyesh, you do? Is it like a full valuation allowance? Yeah? Okay. So we should all check, like, Priyesh's blood pressure then. Okay? Because why would we care? So, like, let's say Priyesh loses $100 as his company. So he's going to do a provision, right? And he's now learned this, like, patented 3-step process that we go through. So step 1, if he loses money, what's his payable? Right, 0. Thanks for participating. Okay, step 2. So we're going to, now we're going to figure out his deferreds. Okay, so how much deferreds is he setting up if he has a full valuation allowance? 0. Okay, so step 1, 0. Step 2, 0. What is his provision? 0. Why does he get paid? Right? He's done. That's it. So that is not going to be on the exam. That is too easy, right? But that's Priyesh's life, right? So when you're, trust me, you can get caught up with some surprise issues if you have a full valuation allowance still. But like it makes for a good joke when you talk about a company that has a valuation allowance because it's sort of like you're on shutdown mode, right? But part of the exercise was also to get you to thinking about other companies that have valuation allowances that you wouldn't normally expect. Like Merck was a perfect example. Okay, so like let's say that Merck had state credits in Tennessee because they hired some people, and Tennessee was like, we love you for hiring people, so here's a huge state credit. But then let's say they didn't even really have tax in Tennessee because they don't really do business there very much. So they have more credits than they need, right? Tennessee was like, we love you, here's $100 million of credits. And they're like, great, I guess we'll take them. But we're only pay like $100,000 of tax every year. So like they should set up a valuation allowance on those credits because they're probably going to expire before the company can use them, right? So a company that looks optically very profitable and not of the type like Priyesh works for you might think, why do they have a valuation allowance? And the answer is because it isn't like all or nothing for a company. It is asset specific. So you need to look at every deferred tax asset and figure out, does that deferred tax asset need a valuation allowance? And because some assets require certain types of income, like capital losses require capital gains, state credits require state income, like a foreign NOL would require the right income in the right country, right? You can have deferred tax assets for big profitable companies because of like nuanced, unique facts, right? So, you know, like next week I'm going to have you read Intuit's 10K, you know, the company that makes TurboTax. And like they're one of my favorite clients because they have this like great, you know, the Valley is so volatile. Like companies come and go, and then TurboTax is just like, just plowing ahead with TurboTax. Intuit just makes TurboTax, and every year they just collect gobs of money. And it's very stable, and they pay a lot of tax, and they're very profitable. And but they have valuation allowances on some things. And so I always think, man, why would they have a valuation allowance? Because like they're just a cash cow. You know, it's just like it's like Starbucks, right? You walk in, you pay money, you pay a lot, it doesn't cost them much, they make money, it's easy. But they might have valuation allowances because of these little weird things. Okay? So you can't assume that just because you're talking with a profitable company, they don't have a valuation allowance. Okay? All right. Valuation allowance. So the rule is that it's facts and circumstances based, but it's a more likely than not threshold. Okay? So you've probably come to learn that there's lots of instances where you use the term more likely than not in tax accounting. So you are supposed to decide, are the deferred tax assets that I have, are they more likely than not to be realized? Okay? So you'd say, if you were GM, you know, is it more likely than not that I'm going to use my NOLs? You're like, I don't know, right? It looks pretty iffy. And you might decide that based on past performance, future projections, like backlog orders, you know, your union contracts, like all the evidence you have to muster, like, what do I think my future income is going to look like, right? So it's very fact and circumstances, but you're supposed to reach a conclusion that is more likely than not, okay? So if you do set up a valuation allowance, you need to set it up to the amount that leaves the deferred that's left as the amount that you can realize. So for example, like in my Tennessee example that I just made up, if I had 100 million of credits and I could use 10 million of them, I'd need to set up a valuation allowance for 90, and I'd leave the other 10 DTA uncovered. Sort of like if I sold Luis my Red Bull for $5 and I thought he'd pay me 50 cents, I'd record a $4.50 bad debt reserve. The valuation allowance can work the same way. Okay? Okay, so the key things that you need to know about valuation allowances are, what you will hear sometimes is that there is a 3-year rule. The reality is, and there is a 3-year rule, but the reality is it's based on all positive and negative evidence. Like if you're an auditor, or a company trying to reach its own conclusion, you're supposed to look at all the facts, the good, the bad, and decide, right? And not all facts are created equal, so some facts might be like really persuasive, other facts might be just, I don't know, maybe, you know. But you're supposed to just use common sense, all the information, make a decision. Okay? Now, if you think about, okay, let me come back to this. So there's 4 types of income that you could use to support a deferred tax asset. Okay? So let's say that we have one deferred tax asset and it's an R&D credit carryover. Okay? We generated a credit, we didn't need it, we're going to carry it over to a future year. Okay? Let's say we were just break even and we had a $100 credit. So then we can use that credit in one of 4 ways. And if we can't figure out how to use it in one of these 4 ways, then we need a valuation allowance. way number one, and you should have seen this from your reading, and actually one of the only sections in the ASC 740 that's sort of easy to read is the valuation allowance section. It's not that hard. So this should all sound familiar. One, if we had income in a carryback year and tax, and we can just carry the credit back and get a refund, well then we don't need a valuation allowance because we can turn that credit into cash by just carrying it back. Right? So credits can be carried back. And if we have tax in the carryback year, then boom, we don't need a valuation allowance, we can use it. Right? That's easy. I mean, that's like automatic. 2, future reversals of existing taxable temps. Okay, that's sort of a mouthful. So let's say that we had a depreciation temp item, and it suggested that we had a deferred tax liability of $300. So that in the future, if I sold my asset for book value, I'd have a $300 tax gain. Well, then you'd say, oh, no problem, I got an R&D credit. So when that tax gain hits, then I'm not going to actually pay tax because I'll use my R&D credit to offset that tax. So you can net deferred tax liabilities and deferred tax assets when it makes sense. So when will it not make sense? Okay, I'll answer that. So it would not make sense if the credit expired next year, but the depreciation difference wasn't going to reverse for many years, right? Because then you'd say, well, I guess that credit won't be there when that depreciation deferred liability hits, because if the depreciation deferred liability is hitting 5 years from now based upon how the rollout of the fixed asset rules work, but the credit expires, then that credit is kind of worthless to me. So I need to be really careful when I rely on DTLs to net with DTAs that they truly will net. Okay? That's important. Like if you had an R&D credit DTA, and let's say like land, a DTL for land, when is the DTL for land going to reverse? Like maybe never, right? Land's not depreciated. So unless you had plans to sell it, then probably never. So then that wouldn't be a good DTL to net with the DTA. But because, oh, go ahead.
Why would you have a DTL for land?
Why would you have a DTL for land? So let's say that you bought a building and it had land and tangible real property. And so let's say you paid $1 million for it, and for books they put 600 to land and 400 to 600 land, 400 to building, and then for tax you're like, oh, buildings are depreciated, so I'm going to go ahead and put all $1 million to the building, right? And let's say that you thought you could defend that. So now you'd have book basis in the land where you'd have no tax basis because of the allocation differences, so you'd have a DTL on land. Like that could happen. It wouldn't be so extreme, but like that could be a fact pattern. Bless you. Okay. Anyways, the point is deferred tax liabilities are future income. Attributes need future income to be used. So it makes sense that if you have DTLs that you probably don't need a valuation allowance on the DTAs as long as those things schedule together. Okay? But there's lots of times things don't schedule out perfectly, so you have to be really careful about that. The company I was at today, they have a huge foreign tax credit DTA carry forward, and in order to use that, we need the right amount of foreign source income, right? So it's not just we need income, we need the right kinds. And so we were looking at like expirations and forecasts, and we were going through that exact issue. Future taxable income exclusive of reversing temporary differences is number 3. So in English that just means I'm going to make money in the future, right? So if I'm into it and I made money for the last like a gazillion years, and you guys buy TurboTax every year, and I feel like I'm just going to keep making money, it's really easy to rely on this, right? Okay. So then what if you're the auditor, like you guys all work for an audit firm, and Priyesh is our client, and then he's like, hey, I'm going to make money in the future. It's all good. We shouldn't need a valuation allowance, right? Do you believe him? You're like, Priyesh, you've never made money yet. Like, I don't know. I'm just making up facts, right? But The problem with that is that's sort of a harder fact to support compared to the first two. Those first two are very factual, right? You can either carry back or you can't. You can either net deferred liabilities with deferred assets or you can't. Future income you have to forecast. So that's hard to know, right? The dependability of the person forecasting, the volatility of the business, right? You know, like I was talking to a buddy this weekend about how like companies that make cameras are just going out of business because like no one buys cameras anymore. Like they're on your phones, right? So like if you were a company that made cameras, you'd be like, I don't know, man. Like it doesn't look good, right? You like might go the way of the companies that make maps, right? There's no more maps. So you have to look at those things and think, well, should I rely on that assumption? That one's very judgmental compared to the first two. The fourth one is tax planning strategies, and this one is rarely used. But like a basic tax planning strategy, like let's say you had an NOL expiring. Well, instead of investing in tax-exempt munis, maybe you invest in taxable securities to generate more income, right? Or maybe you say that land that I had a DTL in, maybe I'll sell it, right? Because I have an NOL, it's not going to cost me any tax to sell it, so I might as well sell it now if I thought about selling it. Like I might have planning strategies that would allow me to use my assets, but you rarely see people rely on that. It's almost always a function of the first three, and even within that, it's usually 2 and 3 that become the issue. Okay? Now, earlier I mentioned the 3-year rule. So let me hop to that. Okay. So with the when we talk about future income as a source of income to realize DTAs, like I was saying with my example, yeah, let me flip forward a couple slides. Yeah. So you can see in this little blue shaded blurb down here, the 3-year test is not in ASC 740, but it was in the exposure draft, which is essentially like the draft accounting guidance that the FASB issues before they go official with rules. So they issue an exposure draft. They say, we think we're going to make the rules like this. They ask for comments, and then they come out with the real rules. Like that's how it works. In their exposure draft, what are the current rules, what happened was they said, why don't we say there's a 3-year rule? So if you have like 3 years of losses, well then we're just going to assume you're in bad shape. You need a VA. You know, by contrast, if you have 3 years of income, maybe you don't need a VA. So people refer to this 3-year rule very commonly. Okay? But the FASB decided not to incorporate that in ASC 740, so it's not actually in the rules. But people still refer to it as being like a really clear indicator of a company's performance and likelihood of future income. And so the idea is, well, if you've lost money for the last 3 years, that's really objective. Like, let's say you're Priyesh and you say, yeah, I lost money the last 3 years. It's been bad, right? I kind of had like no sales and lots of expenses. And then he says to you, yeah, but next year's going to be awesome, right? And you're going to say, well, I'm going to have to believe the past a lot more than what you're telling me about the future, because even if I think you're a good person, it's just hard for me, like objectively, to validate that your forecast is just as dependable as like what really happened before, right? So the 3-year rule, which means the prior 3 years, auditors often look at because it's something that they know as opposed to the forecast, which they don't, right? So there's a lot of reliance on the 3 years because auditors will describe it as objectively verifiable. That's their buzzwords. Okay? And it just means they can audit it, right? And they say, well, you lost money 3 years in a row. You know, that happened. That was real. That makes me feel like there's a good chance you're going to keep losing money. And the fact you say your sales are going to grow 40%, like, that would be great. I want the best for you. But, like, I can't audit that, really. Like, how would I prove that? You know, how can I make that, like, objectively verified? I can't. You know? Of course, if you said, well, the government just signed up to buy all my stuff, and we got a 10-year deal, and they're going to pay me all this money, and I'm surely going to make profit. That's different, but that's not most companies' situations. So when you're in that situation of I'm relying on future forecasts, the three-year rule becomes very relevant. Firms will not usually say, like, that's the rule and, like, the end of it, because they know that's not technically the answer. But oftentimes, as a practical matter, it becomes, like, very heavily focused on that 3-year rule. Okay? Usually companies don't want to be setting up and taking down VAs, like in my Verifone example, right? Most companies either want to have a VA or don't want to have a VA. So, like, Priyesh, do you like your VA? It's easy to do the provision. Companies that have VAs, they like keeping their VAs. It makes life easy. And one of the things that is the easiest about Priyesh's life is, let's say that he has a DTA of $80 for his bad debt reserve. Okay? But then let's say his bad debt reserve is really $90. And he just has it as 80 because, like, he misread it. Like, what happens? Like, he has an error. But what is the correction? So, like, an auditor will audit him and be like, oh, you blew it, man. Like, you wrote down 80, but it's really 90. Like, that's a mistake. You made an error. What does that mean? Like, for most companies, they would have to adjust their deferreds, and then there would be a provision effect. Right? Unless there was some sort of payable effect. But normally for most companies there would be an impact. For Priyesh, he just adjusts his deferred on one side, adjusts his valuation allowance on the other side. He's like, yeah, it's still zero. It's all good. Right? Feet go back up on the table, right? Yeah. So when you're in a VA mode, it's kind of nice. Right? And auditors look at gross disclosures, and so that's not to completely, like, dismiss that Priyesh has to do his job, but that takes the pressure off, right? And companies don't want to set up VAs until they're sure, and so usually there will be these identifiable events, right? You'll see, like, a really big decline in profits, or you'll see, like, some sort of, like, product transformation, or there'll be, like, a plant shutdown or something where you'll be like, oh, that was probably the thing that signaled, like, why we really went from sort of iffy to, like, we've decided we need a VA. Right? Because this is a very judgmental thing, and if you're an audit firm, you like having conclusions like this backed up by evidence. Not just, like, I talked to this guy and he said we probably need a VA. Right? Audit firms need way more than that. And so even though this is a judgmental, common sense sort of thing, you got to think of what all the facts are that support either having or not having a VA. Okay? So I am going to close with two comments. One is the EA situation. So why is EA a funny candidate for having a VA? I feel like this class has become like a rhetorical question session here.
Because they have income?
Because they have income. So, what's up with that? Exactly. Well, so I don't know if you guys all heard what Ozzy said, but Ozzy said, well, maybe it's not U.S. I've changed your answer a little bit. But when you see the income statement, that's not U.S., right? And that's the world. And so when you go down into the tax footnote, I don't think that we took the page. Yeah, we didn't take that excerpt. There's usually a section that will separate U.S. from foreign. But like if you look at this part of the MD&A, where they do 5-year data, and you look at income before taxes, profit, 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 loss, We've been making money for a long time, right? But we got to make money in the right place. And we got to make it for a while and make the auditors believe we're on the right track, right? So, like with a company like EA, you know, sometimes their games are like in favor and sometimes they're not, right? I mean, they have some stable stuff, but then they have games that are successful and games that are not. Like they're coming out with a bunch of Star Wars stuff with the new Star Wars movies, so maybe that's going to be like huge for them, right? But it's not going to show up in these numbers. Maybe it'll be a total bomb. You don't know. A huge product for them is FIFA, right? Like who buys FIFA? College kids. I was going to say people in Europe, but I believe there are also college kids in Europe, so we can give you half credit for that. But like soccer is really popular in Europe, right? And so if that's a big profit driver, then you might expect some of the profits of the company to be disproportionately outside the U.S. because soccer is sort of more of a non-U.S. thing, just as a generalization, right? So it's hard to see from the public disclosures exactly why, oh, they have 3 years of profit. Why do they have a VA, right? Their situation is much more complicated. And while they're doing quite well, like if you look at last fiscal year, they made almost $1 billion. It's more complicated than that. Like you really have to peel the onion, understand the real facts. And when you look at a 10K level, that for a company like this that probably is in, I mean, they probably have 100 entities around the world, and you're seeing it all in aggregate. But yet, when we do provisions, we do them jurisdiction by jurisdiction, right? And so it's hard to look at the public data and necessarily know what the answers to questions like a U.S. valuation allowance is. Right? And that's okay. I mean, a lot of times I want you to read this stuff knowing that like you can't know all the answers, but at least you can try to figure it out. Okay. So homework. There's reading. And then we have a typo. So don't read Facebook. Into it, right? Read into it. We had a little schedule change. So the Facebook provision guys are going to come not next week, but the week after. And trust me, I was just saw some email traffic with them right now, and they're still working. It's almost 10 p.m. They don't want to come. So they'll come when it slows down, which will be in a couple weeks. So for next week, read into it. You'll see they're very stable. So whereas like EA is kind of all over the place, Intuit's very stable, but they have a lot of cool issues. One of the things you'll see with Intuit is they buy and sell a lot of companies, and so lots of disclosures and interesting tax issues about M&A, acquisitions, and dispositions. We're not going to really focus on that in the class next week, but still that's something that's really interesting about them. Do the reading, and then practice. There's really only like one more class, like tonight, where we just do problems, and you just do pencil to paper, step 1, 2, 3, do a rate rec, make it work, and then we're going to move on to other stuff. So it's really important that you practice and you get comfortable with doing a provision. You can play around with the Excel model. You can do it by hand. You can do it both ways. You can do the homework. You can make up your own problems. And we didn't cover the second in-class exercise tonight, so do that as homework and turn that in. Okay? I can tell you guys need more practice, so that'll be more practice. Okay, have a good night.